When markets get rocky, investors look for something solid, literally. For thousands of years, gold has been seen as the symbol of wealth, power, and security. But in today's uncertain economic climate, it's more than just a shiny metal. It's an alternative investment, one that's gaining new relevance that is making investors take notice. Let's start with the basics. Why gold? Gold has long been viewed as a hedge against inflation. When the cost of living rises and the value of paper currency slips, gold tends to hold or even gain value.
Gold is a worldwide asset. It is a global asset and consumed by every walk of life. And we track and trace all of that information and on a quarterly basis provide you that detail.
Joe Cavatoni leads business strategy at the World Gold Council.
That helps you understand what's happening from a supply perspective and how those that want to own it are behaving so you can get a better ability to understand how it could play a part in your portfolio, but also in your life. If you know who's buying and who's selling the asset as a price appreciation asset only, no coupons, no dividends, you'll be better educated on understanding what's going to drive the gold price up.
From the World Gold Council to the famous Diamond District in Midtown Manhattan, Hank Mendelson is the owner of Gold Standard.
When you buy gold, it's only, you buy it where it is. It's approximately $3,400 now. For you to make 10%, it has to go to $3,740. All right. When gold was $400, it only had to go to $450 to make 10%. So, and again, so it was the place to be the last year.
Gold is a lot of things. Maybe we'll get into that later, but store of value. As you know, China and India, of course, consume most of the world's gold, over 50%. And so in a way, it's an emerging market play as well.
But gold isn't just inflation-proof, it's also a safe haven asset. During times of crisis, think recessions, war, or global financial shocks, gold often outperforms riskier investments like stocks or real estate. That's because gold is not tied to the performance of any single government, market, or central bank. It's global, it's stable, and in turbulent times, that kind of independence matters.
Frankly, after 2008, I started getting a little worried about, of course, the banking system here, and I wanted an allocation, in my portfolio to gold.
Dan Tapiero is the co-founder of Gold Bullion International.
I thought, okay, the Fed and, there was TARP and TALF and all of these things. The authorities were going to have to, I don't want to say debase the currency, but in a way they were going to have to keep interest rates, real interest rates, negative for a period of time to offset some of the damage that had happened in 08-09. And so you think as an investor, okay, I'm looking out 10 years on negative real interest rates. So think of that's a zero rate, and let's say inflation's 3%. So if you think about 10 years forward, a zero interest rate with a 3% inflation rate, over that period of time, your savings is losing at least half its value in real terms. The purchasing power will have lost, if I was thinking from 08 out to 18, 10 years, will have lost at least 50% of its value, the cash sitting in the bank. And I thought, oh my goodness, if that happens, I'm just toast. I can't lose that much of my cash. And so I thought, okay, I need an allocation to gold.
So why is gold going up? It's because the Indian central banks, the Chinese central banks, even the United States, they're buying gold. The dollar has a lot to do with it, that when the dollar goes down, gold goes up. You got geopolitical stuff going on. You got wars in Ukraine, wars in Israel, Iran. It's all part of the whole gold mystique.
Gold's story begins far before Wall Street, before modern banking, and even before paper currency. To learn more, we went inside the solid gold exhibit at the iconic Brooklyn Museum. There we discovered more than 500 works ranging from 13th and 14th century Italian altarpieces to intricate Japanese screens, and even contemporary artwork and haute couture designs. Matthew Yogobowski is the senior curator of fashion and material culture at the Brooklyn Museum.
When I first started to research the history of gold, I read about many early stories of how people believed in pre-science times that gold was a combination of golden sunlight and water because they found gold in riverbeds and streams.
Matthew took us on an exclusive private tour to describe how gold has influenced some of the most unique pieces of art over centuries.
There was always this association with the gold, with the heavens, with something spiritual. And because gold didn't rust, it didn't corrode, it was something that if people acquired it, it didn't go away. And that's why people started using gold, for example, in dowry necklaces. So if you, in many cultures in the world where they don't have banks, if you were going to get married, you'd receive a dowry necklace or a dowry earrings. And it was essentially you'd be wearing your bank. Because of that quality, because of its glow, because of its ability to always be stable and not disintegrate, people really felt like if they have a piece of gold, they have something of value, something of worth, that they don't have to worry that it's going to be worthless at some point. It always is a good investment. Gold didn't always have a standardized shape. Today we think about gold bars as being a rectangular piece of gold, but this is an example of gold from 1622 that we have when the Spanish and Portuguese were going to South America and claiming gold and taking it back to Europe. In this particular time, this armada of ships that they had was going back to Europe, and it hit a hurricane off of the Florida Keys, and 2 or 3 of the ships sank. They tried to recover them for years, but they really didn't get recovered until the 1970s. And so here we can actually see how they melted the gold and the shape that it created, which was round. You can see the original stamping on it, how they identified it. Because of our world's insatiable appetite for wealth, which is represented by gold, I mean, we're the ones attributing the value to gold. It doesn't inherently have a value. We're making that. And so we're on this constant quest to acquire more of this rare element. And so there are mines all over the world where gold's being extracted from the earth. And it's not in places you expect, because I think we often think that gold would be coming from the countries that are the wealthiest countries. But when you look at the top 10 gold producers in the world, one of them is America. In Nevada, we have huge gold mines. But then other places are like the Dominican Republic, the Central Republic of Africa, Indonesia. These places have huge gold mines, but they're not necessarily helping the people that live there. So it's interesting when you start learning about all the aspects and dynamics of what goes into acquiring gold. To just have gold for investment, not as jewelry, just buy a few bars.
Where do you even find gold? Coming up, we'll give you expert tips on how to acquire it yourself. And it may be way easier than you think. If you've never bought gold before, the process might seem intimidating. But owning physical gold bars and other gold pieces is actually more accessible than you might think.
Whether it's liquid exchange-traded funds, whether it's futures and options contracts that are listed or over the counter, or whether it's in physical forms that are much more readily available than people realize.
So 47th Street is the jewelry mecca of New York City. It's probably probably the mecca of the world at this point. There's billions and billions of dollars in the windows.
Hank Mendelson gives us an exclusive look inside how dealers, like himself, assess the gold, how much it weighs, how many carats, and of course, how much it may be worth.
So here's a piece that I bought, a watch that was probably made in the 1920s, a Waltham, probably a Waltham, that someone probably bought for $85 or $100. So now you take a piece like this, I put it on the machine. Well, actually, it should say 14 karat. It says 13.6, because when they made this, legally you could make it a half a carat less. So all the old jewelry, they cheated and didn't make it 14 karat, they made it 13.5 karat. And you could see the percentage, it's 56.6% gold, 24.8% copper, 18% silver. It melts for $3,365 today. I don't speculate in the market. I keep the gold that I have, and I try to keep the same amount. If I buy 100 ounces, I want to sell 100 ounces. And this way, if it goes down, every day I make the premium on the coin. It might be 30 bucks. If I sell 100 ounces, it's 3,000.
Gold bars come in various sizes, from 1 ounce to several kilos. They're highly liquid, meaning they can easily be bought or sold in most global markets, though size and brand can impact that liquidity.
That's the important element of working in the physical market and understanding that's a uniquely different proposition than if you were to buy an exchange-traded fund. But what's really kind of interesting about the line of questioning that you're having is that if that's really more important to you right now, that ability to move quickly, then you don't have to own physical gold. You can make that investment in an exchange-traded fund. These are regulated, US-listed products that have immense amount of liquidity and are as easy to buy and sell as a stock. So take a moment and determine, do I really need it in physical form, or can I get it in that financial markets form with a regulated instrument? Both are acceptable, both give you the price performance you need. They have different characteristics, but if that's really your key component of what you want to have, then think about which one better suits your needs.
The key? Work with reputable dealers. Look for bars with proper stamps, serial numbers, and certificates of authenticity.
So the key things that you need to understand is that they're telling you detailed information around what it is you're owning, and they're giving you transparency around pricing and comfort and confidence that when you want to sell, that's a key component, that they stand ready to take your call and take your order. Because when people think about owning gold, they often think about it at that moment of purchasing. And again, many of the attributes of it come along with its ability to help you out when you need it most. And that's why you need to ask that question. Now, there's a trusted network of retail dealers, and we work quite comprehensively with them. But when you get engaged with them, ask those questions. If you're not hearing an answer and you're not getting the confidence that you need around the process for selling, then you should step back. Making an investment in gold is not something you do quick and cheap and free. You put a little bit of energy in it because you're going to hold it long term and it's going to help you out in the long run.
Now that you own gold, what do you do with it? Unlike digital assets or ETFs, physical gold needs to be stored. That might mean a home safe, a safety deposit box at your bank, or a private vaulting service. We spoke to Carrie Lavin, who you may recognize from social media. She has over 390,000 followers on Instagram and has been a well-known fixture in the Diamond District for decades.
I think that you have to buy bullion. I think you have to buy, eagles are a good thing. You do pay a premium for them. I think a 10-ounce gold bar, buying some bullion, Swiss credit, stuff like that. Just take it and put it away, take it and put it away.
Security comes at a cost, and that cost should be factored into your investment plan. It's not just about where you hide it, it's about how you protect your investment.
Why would I buy physical gold and have it stored in a bank that I thought had the chance of going under? That made no sense at all to me.
Before you add gold bars to your portfolio, there are a few more things you need to know. Gold bars often have lower premiums than coins, but prices can vary based on brand, weight, and demand. And yes, counterfeit gold exists. That's why authenticity is everything.
People would tell me, oh, you should buy gold, it's such a good investment. And then the price went up over the time that I worked on the show, and I kept thinking, I really should have bought gold. And I took a lady through the other week, and she told me, she said, well, it's not too late to invest in gold. I said, what do you mean? She said, well, it's at 3 now, but it's gonna go up to 5. So I'm like, she said, it's never too late to buy gold.
Tax rules vary too. In many countries, selling gold may trigger capital gains taxes, so talk to a tax advisor before you cash in.
Gold bars that are Swiss are harder to come by right now because of the tariffs, right? Because if you're importing things from Switzerland, you're gonna pay, I believe it's a 10% tariff on it. And so those bars, which are the PAM bars right here, this is a PAM bar, so this is a Swiss PAM bar. These bars are becoming very, very difficult to get because of the tariffs, right? So because they're Swiss bars, they're a lot more expensive to import.
So if you're a macro investor and you think about a store of value that isn't really debased over time, etc., gold is part of your calculus, okay? And so most macro investors have especially even in the 90s and 2000s, have some percentage of their portfolio in gold, which is, traditionally, long short equity people or traditional equity or traditional institutions, they had that 60-40 model. And gold didn't really play into that.
And don't forget about portfolio strategy. Gold shouldn't be your whole plan. Experts often suggest allocating 5 to 10% of your investments to gold as a diversifier.
The thing that gold does for a portfolio is it definitely protects you on the downside. And what institutions are telling us more and more by their behavior is they're recognizing the fact that it links to wealth and wealth creation and savings, which is giving it that upside performance of about 8% on an annualized basis, going back to 1971, on average. Like this year, we've got a much higher number, but on average, it's tracking the same level of upside return that you would get from global equities.
And gold could drop $1,000 tomorrow. Like I said, nobody thinks it's going to happen. Nobody I speak to. Which could be the kiss of death.
Gold has risen so high. In the history of gold, it's never been at this high. I remember when I started in the 80s, 1980, gold was $300, $350 an ounce.
These are the two strategic drivers: economic expansion, market risk and uncertainty. You'll find that most people will say, I need to be safe. I don't want to see what happened in 2008 ever happen to me again. So they want to preserve their assets. They want to make sure that the asset holds on to its value, and that's what gold does. We have at least 12 to 14 different drawdown moments that we track in modern times. And in all of those moments, what you'll find are risk assets could drop anywhere from 7 to 15%. And gold, on its worst performance, was less than 2% down.
I think gold is going up with the state of the economy. The price of gold is escalating high. Whenever we have shakes in the market, when the market drops, gold goes high. When the dollar drops, gold goes high. That's usually, and what's happening now with the wars that are going on all over the place, between the war in Russia, the war in Iran and Israel, it's just, I think it's making everything very uncertain. I also think the politics that's going on in the country is really a big fluctuation. We've had a lot of things. A new administration changes things. Getting rid of government, it changes the market. So again, the market goes down, gold goes up.
Coming up, the difference between physical gold and the evolving popularity of gold ETFs. If physical gold feels too cumbersome, there's another way. Gold ETFs, exchange-traded funds backed by gold holdings. They're easier to trade, don't require storage, and offer similar exposure to the gold price.
Investors ask a basic number of questions that get them started on the journey. And one of those questions is whether or not I want to have the gold in my possession and whether or not I need to see it, feel it, and want to have it. And if that's the case, then often they will go down the physical route. But understanding that the ETF market is actually very robust, very significant, regulated, and very liquid. It's as easy as buying any stock in the market. And often people get started and say, I don't know enough about physical ownership of gold or what it takes to insure it or other factors of where I should keep it, at home, in a safe, or my safe deposit box, or with a dealer who will hold it for me. But if they want to move promptly, they can step right into the ETF. That's a secure, trusted asset that's fully backed by gold, and everyone should understand those are the instruments you want to own. Fully backed by gold, and the trust that you own, that entity that you're buying a unit of that trust, it takes care of all those things that you take care of yourself. Accessing the gold, storing the gold, insuring the gold, transporting the gold, all of those features are embedded in the unit price that you pay for owning the ETF. We find them both acceptable, and we're actually excited to see people getting involved in both, and often you have people do that. I'll take a little in physical, but I'll keep my liquidity sleeve in the ETF itself.
In a world of volatile markets, shifting interest rates, and geopolitical tension, gold continues to play a unique role.
After '08, what happened was that people more broadly understood that the central authorities, the Fed and other central banks around the world, had the ability to increase the money supply to, let's say, I don't want to say to whatever degree they liked. But the idea behind owning gold, it didn't really come from the market collapse, because we've had market collapses before. It was from the authorities' response to that collapse, which is to have negative real interest rates, to debase the purchasing power of consumers and of, holders of assets, and especially dollar-based assets.
What I like about gold is it's tangible. You physically hold on to your gold. It's not a stock. Stocks go up and down, and you have to tell somebody or give it to a broker or whatever to trade and sell it. You could go sell gold in and out. You go to any country in the world with gold and do business with any country or have an investment in any country with gold.
When people get wealthy, when people actually save, they actually save in the right kind of way with diversification in mind, but they also spend. And that's where you see things like jewelry or maybe some other consumables like electronics at the top of the list of things that they consume. We're a consumer environment in the US. So when things are going well, gold sees that growth reflected in whether it's GDP or spending, consumer confidence, consumption, savings. It's a part of that ecosystem and rising in those types of environments. But when things are going very, very risky and people are worried, the market risk and uncertainty, these are the two strategic drivers: economic expansion, market risk and uncertainty. You'll find that most people will say, I need to be safe. I don't want to see what happened in 2008 ever happen to me again. So they want to preserve their assets. They want to make sure that the asset holds on to its value, and that's what gold does.
So whether you're a first-time investor or just rebalancing your portfolio, one thing is clear: when the world gets uncertain, gold still glitters.